Good evening. Welcome to our latest webinar here. I'm Jenny Mattingly. I'm the Vice President for Government Affairs at the Partnership for Public Service. And for those of you not familiar with the partnership, we're a nonpartisan nonprofit working to build a better government and a stronger democracy. We do that through policy ideas on how to make government work better, leadership development, workforce programming, and really convening conversations like this one to help support current and former federal employees. And we really are here to help you all as you're in this tough time. And I know having plain language explainers, other resources to help you navigate this time are really important. And so that's certainly what this conversation and many of our other webinars are about. And before we dig into the conversation today, I do want to thank all of you for your service. Really much appreciation to the work you have done for your agencies and for your country. So thank you for being here. A few notes for today. Throughout the webinar, we will be answering questions we've received ahead of time, but you can also submit a question anonymously through the Q&A function, and we'll work to get to some of those as well. And I may not be able to get to every question because I know there could be a lot, but we will continue to hold webinars on financial topics as well as other career topics. So if we don't get to a question, please, you can also email us or be on the lookout for more webinars. And we'll be posting all of these webinars to our FedSupport website, which is fedsupport.org. And that'll be in the chat there for you as well. And so you can go back, share this, rewatch it, and watch our other webinars as well. So final things, while this is geared towards current and former federal employees, it is an open forum. We may have folks joining from other communities. And if your question isn't answered tonight, or you have really specific individual questions that we can't get to, we encourage you to reach out to agency HR staff, seek legal guidance, or from an outside attorney, and just continue to support each other. I know a lot of people have learned a lot through this process, so certainly a way to help. Final thing before we kick off, a disclaimer. The content provided during this session is for informational purposes only and is not an endorsement of any particular company or firm. This information is general and provided as an overview of processes and considerations, and really to help potentially offer helpful resources for those of you who are looking for financial experience. What you hear today is not intended to provide any legal guidance. If you require legal advice, we recommend you consult a qualified attorney who can assess your unique circumstances. So with that out of the way, I'd love to welcome back our guests who are joining us to help answer these questions. And Nicolas, Delante, would you please briefly introduce yourselves, and I'll let you flip a coin for who goes first.
I'll go ahead and go first. Thank you, Jenny. Good evening. It is a pleasure being back once again. We were a couple months ago, we were here and had such tremendous feedback, so glad to be back once again. A little bit about myself, Nicolas Abrams. I am a certified financial planner with the firm Opulentia. I have been in the financial services industry for 25 years. I founded this firm back in 2009, and we have been working with federal employees since 2012. And really working at the national level, doing training for several organizations, federal employed women, Blacks in government, on the national, regional, and local levels. So really excited to be back once again. I founded this firm really because my passion is working with clients and working with people. We wanted to make sure that we put our clients first. And that's very important, as you're looking at financial planners, financial advisors. We are a boutique firm that focuses on our clients. And we are, like I said, really excited to be here once again. And I'll turn it over to my associate, Delante.
Thanks, Nick. I appreciate that, and I appreciate you. A fun fact is, before working with Opulentia, I was actually a client here, and I was a municipal employee. My mom is a federal employee and was at the time that I met Nicolas and our other business partner. And I wanted to figure out how do I use these talents that I've acquired to build my own future. I didn't feel secure as I should have as a federal or government employee. And I'm sure a lot of people could relate to that right now. So I wanted to know, how do I build an exit plan? And so we put together some strategies. It worked out pretty well. I've been with Opulentia ever since. I am now the Chartered Federal Employee Benefits Consultant here, which is basically a specialist. So I'm a financial planner in a whole, but I specialize in helping federal employees to maximize their benefits. And in addition to what Nicholas said earlier, we're fiduciaries by trade and by ethos, but also because I was once a government employee and my mother's a federal employee, we want to go that extra mile and make sure that we're here to help you all. So looking forward to today's session.
And I think that's a great, theme that carries through so many of us, is wanting to help people right now as they navigate this, because there are just a lot of questions and a lot of unprecedented experiences that people are having in their career. And so really thinking about that financial piece, I know, can be stressful for folks, especially like you said, Delante, you don't always think about that
Yeah.
when you're in the moment, or no, it's just not a current consideration really. And so that's what I'm hoping we can get to this evening, is talking through some of the things you're hearing from folks out there that would benefit others. And so that's a great place to start. Is you've had a lot of conversations with folks, you're hearing from people a lot. Where are you seeing that they need the most guidance, support? Like, what are the big topics that are top of mind for you that you're hearing from folks right now?
I would say one of the biggest challenges that I'm seeing, and I'm sure Nicholas would agree, is that people are making major decisions like accepting a VERA or a DRP without a clear understanding of their financial situation. We've sat with multiple federal employees who have accepted an early out, only realize later that their retirement income doesn't match or surpass their retirement expenses. And we've had others who have underestimated how long their TSP is going to last, and also how taxes would affect their take-home pay once they make their withdrawals. So, in a nutshell, I would say the three biggest things would be to make sure that when you're looking at all the numbers, your true retirement income needs to match or exceed your true retirement expenses. And we have to look at everything. You can't just guesstimate those numbers. You also want to make sure that your FEGLI and your TSP are coordinated alongside your pension and your Social Security. Not everyone is going to get the Social Security supplement, so don't just assume that it's going to be there for you, and that could lead to a gap in your income. And also clarifying what early separation or buyouts really mean for your long-term income, because we're seeing too many people signing up and agreeing to, basically change their life without running the numbers, and we don't want that to be your story.
Yeah, I would say, Jenny, another thing that we're seeing is really the difficulty accepting the situation. A lot of people, and I'm sure on this call, you've dedicated your life to service to the federal government, and then being forced out, and that's the other part of it, whether it's been you've worked 10, 20, or 30 years. Even we're seeing it in people who are retirement eligible, but still just the acceptance of knowing that they're not leaving on their terms. That's very hard to deal with. And as Delante said, I think one of the biggest things that people have to look at is taxes. Even what we've seen with people, when they get their leave pay, underestimating how much the tax burden is going to be on that. So you look at the number, I have all this leave, and you think you're going to get a huge, bump, when you walk out the door and take the leave pay. But understanding that the tax ramifications of that is very heavy. So that's one of the first things people say. And as Delante said, and I know we'll get more into this later, just understanding what your retirement income is versus your expenses in retirement. That's been a very huge misunderstanding for a lot of people. And we've had to sit down and have some very great, sometimes hard conversations, but also some very good conversations with people on how to navigate that and make that work for them.
Yeah, and maybe that's a good place to start. I know we have lots of things we want to jump into and cover, but really we've talked about, as people approach the DRP end date here, if they haven't done that planning, how should they start thinking about what the income is that they might need? I know some people are looking at getting another job, but others are just retiring. How should they be thinking about accurately trying to assess what is it I need? Because that will also help them think about what salary they might need if they're taking a new job, or what benefits. How should they even start thinking about that, aside from working with somebody who in the financial planning who can help them? But there are probably some tips you have too.
Yeah, I would say the first step, look at your expenses for the last 3 months. Realistically, what you're spending money on. And I never like to call it a budget. I like to call it a spending plan. Look to say what you're spending money on, and that's everything. And this is where the rubber meets the road. We have to have that honest conversation. Sit in front of the mirror and say, okay, I've got to do this. Put down what you're actually spending money on and take a hard look at it. A lot of times we all have things that we spend money on that as we're going through this next phase, whether it's retirement, partial retirement, that we can make some adjustments on. But if you don't have that honest conversation with yourself first, even when you sit down with a professional, you're not going to get the right numbers. So people say numbers don't lie, which is true. So we tell people, look at the last 3 months, what your expenses are. And then from there, you can start to figure out, what your pension is going to be if you're retiring. The biggest factor is how the TSP will play into that, but also Social Security or the Social Security supplement if you're eligible for that.
And then, oh, go ahead, Delante.
Sorry about that. I just want to piggyback on that. So there are a lot of moving parts in that income versus expenses conversation as well. So for instance, if you're looking at your last benefit statement, you want to confirm that your service record and your high threes are accurate, because if those aren't right, then your annuity supplement or your annuity won't be correct either. Another thing is going to be making sure that your beneficiaries reflect their current wishes, because not everyone's going to step into their next career. Some people honestly may forget about some of the benefits that they're leaving behind, and that may not match their home situation. So keep that in mind, that as you transition, you still have these assets or these benefits here that you want to make sure are filed properly. And Nick mentioned something that's really important, is having an honest look at those expenses. That's also going to include FEHB for some. Not everyone's going to be able to carry their health benefits over into this transition or to their next position if they have a next position waiting for them. And that can be a large expense for some, because now you're carrying the entire cost plus 2%. And so if there is a gap, that's where the panic starts to come in, when you don't have that spending plan or an income plan. So what most people we're seeing are doing is, if they don't have a plan, the first thing they want to do is start making withdrawals from their TSP. And that can be a huge mistake, because you don't, well, let me not say you don't. There are some people who are not taking into consideration that there can be a penalty. Some people are pulling out too much money too fast and creating a tax headache for themselves. Or you might have the polar opposite, where it's like, hey, I don't know what tomorrow holds. I'm going to stick my head in the sand like an ostrich, and I'm just going to square everything away in the G fund. And now it's sitting too conservatively. Then when you need to use it later, it has not grown in the same way that the economy has. For instance, some people have not touched their TSP since sticking it all in the G fund in March when things were going crazy. The market has rebounded over 20% since then. We're still talking about tariffs. We still have cost of living. Inflation has not been tampered completely. So that money that you had back then and you just squared it away, now you may need to reach into your TSP to withdraw it, and your spending power has diminished. So as you're getting closer to the separation date, I know it's the 30th, but start having the conversations as soon as possible so you're not blindsided by one of those nuances.
You are making me wonder if my TSP money is sitting in the G fund right now. So that's a good reminder for all of us, because again, that's one of those things, this was such an abrupt transition for folks. It wasn't something on their radar of where it needed to be. You've talked a little bit about the separation date coming up for folks on the DRP. For many, it's the end of this month. Are there other considerations or steps besides checking their, making sure their dates are correct, or starting to think of an income plan and looking at spending? Are there any other things they should be thinking about right now in terms of this date of separation coming up?
Yeah, I would say, think about what's next. Don't think of this as an ending. Think of it as a beginning. There's a lot of opportunities still out there. There's new chapters to hold. So as we're talking to clients, it's funny, I was telling somebody the other day, we've gone from financial advisors to life coach, it seems like, with this whole transition. Take an assessment you are in your career, and now's the time there's always something you've always wanted to do. Now's a good time to look into that. And it could be something as a totally new career path. I've seen that. We've got some clients who left early in the year. They're looking at pursuing going into education, doing some, teaching on the K through 12 level, but also looking at the higher education in college. We have some people that's going into consulting, that they're using their government skills and they're going to do some consulting work. So we've seen a huge range of opportunities out there. So we always encourage people, if you're not ready to make this your last call, now's the time to think about what's next and start pursuing that. Take that opportunity. Look at it as a blessing, that you're now able to move on to another chapter, because a lot of people don't get that opportunity, and look at it and take full advantage of it.
I like that reframing. It makes me think, and this is not a question that the three of us have discussed before, but in hearing you, remind folks about being able to move on, and particularly about going into education or other spaces, I've heard from some friends who are going into new careers where there's a different pension system, a different, pay system. Are those things, as people are coming out of federal government with a federal, having put into a pension, are there things they should be considering if they're going into a different governmental system, or even just a different career, that they need to be thinking about with their FERS benefits or with other financial considerations?
I was gonna wait for the hot take moment, but
We're doing it now.
yeah, I think this is a time to be very proactive about understanding finances and benefits, because the structure of the federal government is changing. It's becoming more like a private corporation. You're having mass layoffs. They're saying up to 300,000 people are going to be gone by the end of the year. They're looking to make wages more competitive, but they're trying to reduce unions. This all sounds very corporate. And so, where it used to be a completely different system, you now have to take a lot of things into your own hands. And a part of that is going to be either understanding how to put these benefits together to build a stable package for yourself, or putting a team together. It's not negotiable or an option like it used to be. And so, I think, especially to Nick's point, is having the serenity to understand the difference of what you can and cannot change in this situation, and then finding a way, or someone within your support system finding a way to make it work for you, because it is a transition, but you also have learned some skills along the way that can make you very valuable, whether in a corporate setting, or if the government decides, which it seems like they're leaning towards, to make the salaries more competitive. They haven't released the GS schedule, so please don't jump on me about that. I've been looking. But they haven't released it, but they want to make it more competitive because they want to have a performance-based scale. And so with that, you have to pay people based on their performance. So if you're someone who has done well, this could work to your advantage, but you have to understand that the game is changing. So on a high level, some things that you can do in the short term are just pretty much stabilize the things that you can. Your emergency funds, try to make that as close to 6 months as you can. I know that that's a stretch from what people are normally taught of 3 months, but we're in a very interesting time here. I mentioned it earlier. Once again, health coverage is going to be important. Earlier this year, we mentioned it was already up 13% from last year, and I don't see that slowing down anytime soon. And managing your debt. That doesn't mean that you have to pay everything off right now, but just being intelligent about how you service your debt, paying attention to your interest rates that may have changed. For instance, you might have bought a home on an ARM loan. You may have some credit out, I'm sorry, some consumer credit out there that you're not paying attention to that's costing you a few extra dollars, and that's eating into those cash reserves that you have. So initially, just control what you can, and then do the best thing for yourself in educating yourself and the people in your inner circle about retirement benefits, risk management, and if that is not your specialty, get a team together that does understand that.
Yeah,
Yeah,
sometimes.
and I would say kind of on that, just kind of follow up. Really, if you're looking, like you're in a situation where you're looking at another job, and you're blessed to find another job that does have a pension, that's going to help you a long you are when you leave. If you're keeping your health benefits through the federal government, then that gives you a lot of flexibility looking at another job where you don't necessarily need their benefits. So those are some key things that can really put you in the driver's seat and even negotiating with another company, saying, hey, I've got benefits, so I don't need your benefits. I need more money. So there are a lot of opportunities there for people to help negotiate, to help further their career.
That's a great point about thinking how these things interplay with each other, because they do make a difference. And we are getting some questions about some of the things you all have mentioned already. One, going back to, as we're talking about pensions here at the federal and state level, one of the listeners asked about taxes on pensions and whether that is, can you explain, are there taxes on pensions? What should people know about that?
Yeah, so with that, and there's two components to the first pension. There's the money that you're putting in, and then there's the money essentially that's being added from the federal government. So the money that you're putting in, that money does come out tax-free. It's kind of a formula that they look at when calculating your pension. But anything outside of that amount that's been put in on your behalf, that is taxed as ordinary income. So that money, just like your paycheck, when you get that money once a month, you do need to withhold both federal and state taxes from that, because that's, well, depending on the state you live in, let me put that disclaimer there. But it's counted as ordinary income, where you will have to file that at the end of the year and pay taxes on that money.
And does that hold true as well for annual leave lump sum payouts too? And because Delante, I think you mentioned people, if they are getting their leave, or Nick, maybe it was you, about they should expect taxes withheld on that.
Yes, taxes are withheld from that. So that's on your last paycheck. They will add your annual leave, and it is taxed, and it's generally taxed at a heavier rate, because that's a sort of an exceptional, almost a bonus type payout that's going to you. So, and I did mention earlier, a lot of people are seeing, they get the number for their annual leave and get excited. But when they see what they actually get, that disappointment comes in really quickly. So that is taxed, yes.
And to piggyback that, another nuance to not just the income when you're starting to receive your pension is you no longer have the tax exemption of contributing to your TSP. So now your adjusted gross income more than likely will be higher. You may find yourself in a higher bracket, or if you're closer to paying off your home, and this is a conversation that we have with a lot of people, whether it makes sense to pay off the home or to keep it so that you still have your mortgage interest. So you have to take those things into consideration as well when bringing that pension in. Otherwise, you could find yourself in a higher bracket.
And a related question to that I'm seeing in the from the folks on the line is around TSP. If they retire, for instance, if they have, either early retire or full retire, and they take money out of their TSP, do they get taxed on that? Can they take money out of their TSP, or do they have to wait till a certain age because then tax penalties kick in? How does that work?
So there are a couple of nuances with that. Once you are age 55, you can take money out of your TSP and you can avoid what's called the early withdrawal penalty. That's a 10% penalty. So you can take money out. If that money is in the pre-tax or the traditional TSP option, then that money is counted as income. If you have money in the Roth or after-tax portion of the TSP, that money can come out tax-free. So that's sort of one scenario there. You have the option to leave your money in the TSP, or at any time when your service separates, you can transfer that money to an IRA. And that is a non-taxable transaction, because you're going from one retirement account from another retirement account. It gives you more control, more flexibility on how to manage the money. You can change your beneficiaries without having to get a spousal consent. And that's a big thing for some people in the times we live in. Divorce rates are high. So with an IRA, one of the benefits is you're able to change your beneficiaries without having to get any type of spousal consent. So you can name anybody your beneficiary to an IRA. And it gives you, as I said, more flexibility, more investment options. But once again, when you take money out of the TSP and it goes into your individual pocket, depending upon how it's set up, if it's set up on a pre-tax basis, that money comes out. You do have to pay income taxes on that money. The money that comes out from the Roth portion or after-tax portion can come to you tax-free.
Yeah, and that's another question that is just for me as I'm listening to you all, and it was something I learned coming out of the government the first time when I had a TSP. To your point, you don't have to take your money out of it and roll it into something else. It can stay, and you can actually, if you have other jobs subsequently, determine at some point in the future rolling those retirement accounts into your TSP. So. And so I think that's just another consideration for folks as
Oh, yeah.
taking new positions. Is there any difference in, we've been talking about folks coming off the DRP here at the end of the month, but there are other folks who were RIFed. They were separated from service already. Are there immediate financial first steps that are different from folks thinking about a DRP that they need to or taking Vera if they've been RIFed and separated? Is there anything that you've been hearing or seeing on that front?
Absolutely. So I'll go back to what I said earlier about stabilizing yourself first because the rift is sudden. The Vera and the DRP at least give you some time to plan out your next step. It's not a lot of time, especially to Nick's point earlier, where you're processing that, hey, this journey is over a lot sooner than I may have expected. For some people, that's a good thing. For some, it isn't. And if you haven't planned your next move, you need to get on stable ground first. You want to make sure that your immediate needs are taken care of. Versus with the Vera, I mean, you may have an opportunity to start your retirement income a lot sooner. You want to make sure that you're assessing that, as I mentioned earlier, to make sure that your records are accurate because you're going to start receiving that money almost immediately. But that could be a smaller annuity. And if you haven't taken a look at your expenses and your overall situation, it may end up resulting in you having to go back to work, whether that's for the federal government or for another entity, where you assume like, hey, I'm just going to get the same amount from my last SF50 and I get to sail off into the sunset. And we've had people who have a huge income gap because they didn't have an opportunity to look at those numbers beforehand. With a RIF, that's pretty much going to be sudden. And there have been some court orders where they're going to allow it. We don't know which agencies. There are whispers. We hope that it's no one that's on the other end of a RIF. But the first things that you want to do is, first make sure that you have your emergency savings. If you don't have those, what assets do you have that can help you to get to your next step? If it is a TSP, and I know we mentioned earlier, you don't want to take it out too early, there's a penalty with that. If that's what you have to do, that's what you have to do. But let's build a plan around it. You don't want to just do things because emotions are high. And when we're stressed, a lot of times we get tunnel vision. So a lot of times it's going to be, hey, I'm making this move for the next 2 or 3 months. And as we're doing that, let's layer a plan behind. Let's figure out what you're going to do in 6 months. Let's figure out what you're going to do in a year so that we can get you back to a position where you're making sound decisions. And I think that's the biggest difference is having that time and there's a not a promise, but there is a agreement that you're going to have income from the federal government later versus with the RIF, you don't know what you're going to have, especially if you aren't vested.
And can you, just for folks on the phone, and I'm guessing people already know that, but talk about what qualifications you'd need to meet to be vested?
Yes. So in order to be vested for, let's say, something as minuscule as, hey, I want to access the money that I put into my pension. You need to be with the federal government for at least 5 years. If you want to turn that same benefit per se into an annuity or your high threes, which is going to be basically a retirement annuity that the government has funded for you or a portion of it, then you need to have at least 20 years of service at age 50. Or at any time, if you have 25 years, you can have a Vera, and that means that you're immediately able to go into retirement, which means you have your retirement annuity that's coming in. If you're not old enough, so if you're not 57, you may not get your Social Security supplement just yet, but it will kick in later. So that could be an income gap. So you want to keep that in mind. Also, you have access to your benefits in retirement. So if you already have FEGLI, you will be able to continue that. You definitely want to take a look to see if it makes sense for you to keep that temporary life insurance that they're offering you that resets every 5 years up to age 65, or do you want to go with something private? Also with FEHB, you'll be able to keep that, which will help as far as your expenses. If not, then you have to go over to TCC if able, or you have to use Cobra, which can get very expensive and only last for about 18 months. After that, you're on your own. You have to go to the marketplace for the Affordable Care Act, and whatever are the premiums are that year, that's what you have to choose from. And so I think those are some of the biggest differences, is not just the mindset of being able to buy time, but there are benefits and assets that you've earned from serving the federal government and the people of the United States that are promised to you as long as you've been with the federal government long enough. If not, then it's time to take everything by the reins. Don't take it personal, but personalize your plan and build your transition.
And so you've said a couple things that maybe I'm writing down questions so I don't forget, because it said, you've said a couple things that make me want to tease out some of those issues. Um, you've talked about early retirement. I know there's also deferred retirement.
Mhm.
People can defer that. And is that, uh, again, if they're not, if they're RIFT, obviously the option is hopefully before you're RIFT, if you're eligible for retirement, you take VERA. Is there a
Mhm.
way to take a deferred retirement? Is that an option for folks?
Yes, but the agency has to offer it to you. And it's different from the VERA. The VERA, you're going straight into retirement provisions. So the income is supposed to be there for you. You have access to the benefits. They offer you the VERA once you qualify. The DRP can happen to anyone. And an agreement for you deferring this resignation. So you're basically putting yourself on admin leave for this DRP. It's going to be to September 30th. There may be some that are longer. After, let's say, October 1st, they may offer even more of these. But you have a set date that is the agreed upon end day for your service with the federal government under this current role. In exchange for you walking away and helping them to rebalance their books for the next fiscal year, which is why they offer it, they're going to pay you an agreed upon amount based on your hourly or salary rate, and you're going to have that up until that date. But that is a resignation. I don't want to use the Q word, you're resigning in advance. Usually, when you resign from a job, you don't get to keep your benefits. This is no different. Now, if you're vested, then yes, you can apply to retire after the DRP, but it does not automatically qualify you for retirement. And so that's important because those benefits that I was mentioning earlier, if you don't already have enough service for those, when you finish out your DRP, you're on your own. You have to put these benefit package together for yourself. So remember earlier when I said I wasn't going to go into the hot take too much, but just another nuance as to how this is turning into more of a corporate job. Usually, when a corporation wants to please their shareholders or increase their bottom line, they start to shave off fringe benefits, right? So in 2022, they got rid of the federal long-term care program. Long-term care is important. It's expensive, but it wasn't numerically making sense for all parties involved. So they cut that. Now with the DRP, yes, I'm going to give you your salary, but you're on your own. Once we're done, we're done. You are no longer on the books. Now, if you retire, yes, you can come. Let's say, for instance, you do a DRP today, you have all your years, but you're not old enough to start receiving your income. You can come back. And at that point in time, we'll pick up the conversation. And if you're vested, if you have enough time, then I'll offer you the benefits. But in the interim, so if you're 40 years old and you took the DRP, come back in 15 years. But for the next 15 years, your health benefits, your dental, your eye, disability, all that stuff, that's up to you. When it's time to retire, we'll talk. That's the difference between a Vera where it's saying, hey, Everything that I promised you is still there. I'm just going to shave a little bit off the top because you didn't work as long as we initially agreed. Does this number work for you? You get to keep all your fringe benefits. Here you go. You're off the books. So sorry for the long-winded answer, but I hope that explains the
It's
difference.
really helpful. I mean, because there are so many different considerations, right? And I know so many folks who are leaving federal service that have like the years but not the age, or they've got the age but not quite the year. And so there's just a lot of questions on all these different things. Another question this brings up, and I don't know if you all are seeing this, but once somebody comes out, say they take Vera or they retire, how long does it take before they're starting to receive a pension? Because that's the other and Nick, I see you laughing, but I think people don't always realize, and my assumption is that you have to plan that you're not going to get retirement checks right away, and they may not be up to the full amount right away either.
Correct. That's correct, Jenny. So, I mean, we're telling clients prepare for at least 3 months at the minimum. And I think it's going to be longer because we've got this huge wave that's about to hit. And then always at the end of the year, there's always just naturally a lot of people who retire. So the end of the year has always been a longer wait to get that check. And your first check is a half a check. When you do get that check, it's a partial check. So at minimum 3 months. I mean, I tell people honestly, prepare for 4 to 5 months. Just because there's a lot happening, there's a lot of processing going on. So it's going to take time to work through the system. And I was talking to somebody last week. They were riffed in July, and their paperwork still had not gone through when we talked about 2 weeks ago. So they're not even in the system as being retired yet. They were retiring. So it's going to take a while for all of that to happen.
And that's
So what we tell people is, a couple of options. One, as Delante said earlier, you want to make sure that you have some money set aside to help cover you for those months that you're not working, because that's going to be very important. But that's where that leave check, that annual leave money, so when you get that, don't just go crazy and spend it and treat yourself. You want to set that aside to kind of help as well go through that process.
Yeah, and that's another thing I've been hearing from folks too, is that paperwork isn't even showing up in there. So I think there's a little, and as you said, more folks are going to be entering into the system here. So I think it's a good reminder to people to hang tight and plan, because we're not quite sure what we're going to see through this. Speaking of paperwork, that's my final question that I was scribbling down for this particular moment. I know I will have more, but that I wanted to ask is that, Delante, I think you mentioned, check one of the first things to do is check your paperwork, make sure you have all your statements to make sure it's accurate, right? And there are a variety of reasons why maybe the service calculation isn't correct, or, the dates aren't correct. What happens when somebody gets their paperwork and it's not correct? What have you been seeing folks do, or how often does that happen where they really need to, it's missing something and they've got to get it fixed?
Well, I'll start off by saying that mistakes happen, but when it's a mistake with your paycheck and you're dependent on it, it's a lot more stressful. And so what we've had people do whenever they've encountered this is request a written annuity statement, and you check it against your most recent SF50. So you have that, your service record, and your high three. You want to assess all those things to make sure that your numbers match, because the mistakes oftentimes are going to happen with the military buyback and then the sick leave credit. So if those don't add up, what ends up being the situation is I need to accept some type of income right now because, like we said earlier, some of these things have been abrupt. I need my check. So I'll take what you give me now, but now I have to go get in a line that's as long as a little boo-boo doll line to file a complaint. And I don't know when, a live person is going to get back to me. And so now I have to adjust my financial plan based off of, let's say, for instance, I was already expecting to take a 20% cut. in my annuity because I took a Vera. But now there's another 10 or 15% missing. I have to adjust my entire plan. So it goes back to before you sign anything, assess everything that you can, line it all up, and keep a personal record of it. So I know that some agencies are not allowing you to download the documents anymore. I'm not giving advice one way or the other, but find a way to have your own copy of this paperwork. If not, you have to go back, even after you've retired, and request it. Not demand, request. And we don't know if you're ever going to get an updated adjustment. So if you can, do it as soon as possible, save a copy somehow, and that'll save you a lot of headaches.
Yeah, and that's, and I think for some people, we're seeing that they are able to request it through, through OPM or through their agencies or through, National Finance Center or somebody that's servicing their checks. So there are ways to request this information.
I did forget a point. I know I mentioned the beneficiaries earlier. If you have a child who is aged 24 or 25, please make sure that you send out the notification to remove them from your FEHB. It does not automatically drop off from your premium, and we have had it where some people have paid those premiums for years, and they have to once again request a refund of the surplus, and there's no guarantee because they're not obliged to pay you that back.
So we need to do that quickly. Delante, I think is it just my end or can you?
No, I can see it. There's definitely a lag here.
So I know it's amazing when you can see yourself on on screen, but that's fascinating because that's the first time I'm hearing that about, and I'm sure other people may or may not know this about having to request getting adult children off, and that doesn't just automatically happen.
Yep, it's in writing too. I assume the same thing, but it's in writing that it is your responsibility as the insured to notify them that you want to remove them off of your premiums.
Yeah. Huh. There are so many things to sit here and think about. Um, I do want to take a moment to step back because we've talked about so many different issues for folks. And I don't actually know if everyone listening knows how federal annuities are calculated and how they start. Because we've talked about making sure your paperwork matches and that you're thinking about what you might receive, what you need. Can you talk a little bit about how the annuity is even calculated and how they would even estimate what they might be getting?
So yeah, the number is based off of what's called your high three. So that's the average pay for the last 3 consecutive years of service. So they take that, they kind of take an average of that number, and that's like your high three. So that's what the initial number is based off of. Then from there, there's a formula that depends on how long you have been working for the federal government, when your retirement age is going to be. So if you're, under 62 or you're age 62 with 20 years of service, it's 1% of your high three for each years of service. If you're 62 and older with 20 plus years of service with the federal government, then it's 1.1% of your high three salary for each year of service. So that's sort of kind of the base way to calculate that. And you can find that information. It's on OPM. If you look under OPM, under FERS, and annuity, it'll show that calculation, how you can calculate those numbers.
And I think there is on the OPM website a calculator.
Yeah.
You might have to, yeah. So people can look at that. And I'm seeing in the chat, or in the questions here too, is similarly thinking about what your retirement annuity might be. Is there a way to estimate what FEHB is going to cost them? Is there, do they still have a cost associated when they go into retirement or at any other time they should be thinking about their health benefits?
Yes. Unfortunately, we don't have the answer as to how they predict that for the following year. So you will be responsible for a portion of your FEHB, but health benefits are on the inflation plane. So whatever it costs the insurer to make sure that you have coverage, that's going to be based off of their claims for the previous year, their admin fees. That's all rolled into one. And so that cost is passed down to you as the policyholder.
Is there similarly, and it's a question that's in the Q&A, but it's also one that, as we were talking about health insurance, was occurring to me too. If there's a lag in getting your retirement um, benefits coming out once you've retired, getting your paperwork processed and getting your first payments or so, is there any lag in healthcare or having to do that? Should people be prepared for anything in the meantime?
They should be prepared for anything. So you usually have 31 days of continuous coverage, depending on the agreement that you sign. So if it's a Vera, you should be good. Should still have access to the federal government's version of healthcare. If it is a DRP or a RIF, that is not guaranteed. So after that 31 days is up, you may have to elect for temporary continuation of coverage, which goes up to 18 months. You may have to go to COBRA for 18 months. There is some flexibility when it comes to COBRA as to when you actually file. So that's something that takes a long time to explain. So in a nutshell, you can kind of buy some time, and if you need to use it, then activate it. But you have a very short window outside of the open enrollment period before you're able to do that. But other than that, what most people are doing, we've seen people who go get another job just for the health benefits. It's not ideal, but with the cost of medication and care, what are you going to do?
Yeah, that's absolutely right. You have so many costs to juggle and think about as you're making these plans. One of our folks watching the webinar has asked a very good question. That's a good reminder that we're sometimes using terms that aren't always familiar, and wants to have you explain, are annuities and pensions the same thing? Because we've been using the words interchangeably.
Great question. And I always jokingly say one is the left Twix, one is the right Twix.
That's a good way
And
to say it.
they are essentially the same thing. So, not to be too complex, I'll explain a few terms that I've used here. So, if we think of the TSP, that's an accumulation vehicle. That's designed for you to build up a savings account, basically. It's not intended for you to spend, it's intended for you to build. An annuity is built for you to maximize those savings as you turn them into income. Whenever you hear the term annuitization, it's basically saying, how do I turn this account into cash? And so when you have a pension, it's an annuity, it's just funded by your employer, it's structured by your employer. So when you put your pension contributions in and they match, you're funding an annuity together. You're funding a strategy that's going to take a lump sum of money and turn it into a continuous income stream for you, either for a fixed period or for the rest of your life, or for your life and your survivor benefits. If you go to a private annuity, you have the exact same options. It's built the same way, but it's funded from you and your account. So in essence, yes, they are the same thing, but just like you have a 401k versus a TSP, they're both employer structured retirement plans, but corporations use the 401k. Since it's the government's the TSP, it's a different name, does pretty much the same thing.
That's
And
helpful.
so from the FERS standpoint, when we talk about FERS, you'll hear us say FERS annuity or FERS pension. Technically what that is, those are one and the same. So that is when you retire, there's a check that you're going to get for the rest of your life. We use those terms interchangeably, but they are the same. So for the first aspect of it, it's your FERS pension or your FERS annuity. That's the income you're going to get from that
while we're talking about clarifying terms and something that I know we've talked about, TSP, we've talked about pension and annuity, we haven't really touched on where Social Security plays into this. So for folks who are thinking about retiring, there is a Social Security component too.
Yeah. And there's actually two components. There is a Social Security supplement that some people, when they retire prior to age 62, they will be eligible to receive. So it's a payment that you get in lieu of getting Social Security up until age 62. So there's that portion of it. There's also what is true Social Security. So the earliest that you are qualified to take payments from Social Security or receive Social Security is age 62. That's when you can file and you can start receiving your benefits. One of the caveats with that is if you are planning on working another job, you are limited to how much money you can earn in a given year or you're penalized. Generally, it's about between 18, 19,000. If you earn more than that from another job, then you are penalized for taking Social Security early. Then there's a normal retirement age. For most people, it's going to be between age 66 and 67, and it's based on your birthday, year of birth. Once you reach normal retirement age and you start collecting your Social Security, you can then make as much money as you want. So there's no penalty at that point in time, but you have to wait till you get to that normal retirement age to escape any penalty. And yes, there are taxes on your Social Security benefit. That's a question we get all the time. A portion of it is taxed. And it depends on your income, what that portion is, but there is a portion of it that's taxed. The maximum amount that is taxed is 85% of your benefit.
That's helpful because I think that's another one of those considerations, as I've heard you say, that people might be estimating Social Security one way and then being surprised when it is
Oh,
not.
yes. Yeah.
So I know we want to be cognizant we're getting close on time, and I do want to hit you all up with like hot takes, anything we haven't talked about. I have one I'll throw at you, but before we get to these final things, we are going to do, for folks on the phone, a quick poll, and it'll come up. We can still keep our conversation going while folks see the poll. And it really is a chance to give ideas about other sessions that would be helpful, topics, things like that. So just 3 quick questions, and really appreciate people taking the time to answer those. And while they are doing that, would love to hear just your final wrap-up thoughts, things that we haven't covered, things you want to go back and a final point to hit home on for folks listening today.
Yeah, I would say, Jenny, understand this, everybody that's listening, live or hear the recording, you do not have to do this alone, and you're not alone. Don't be afraid to ask for help, seek guidance going through this. There are a lot of nuances, as we talked about, with federal benefits. It is one of the most complex benefit structure out there. With, depending upon when you started service and the different, whether your special provisions, so there are a lot of different things out there. So if you're looking to make this transition, whether you're going to voluntarily do it or you're involuntary do it, seek help from a professional that can help guide you through the process. I think it's very important. You don't want to do this alone. You really get one shot at this. With everything that's going on, the landscape in federal employment is going to be changed forever. And if you have to leave, you want to make sure that you leave on the right benefits. You selected the right options, because there's a lot of paperwork that gets thrown at you, and you have to make some very tough decisions. Something we didn't talk about, when you look at your pension, if you're married, do you first pension or first annuity? Do you choose a survivor option or not? And the pros and cons of that. So those are things that are going to come to you. You get the paperwork, and you want to make sure you're making the right decision on that, because making the wrong decision can be very costly, not just to you, but for your family and your beneficiaries. So put together the right people, seek help, seek guidance, and navigate through the process, and have that outside opinion, those people there that can help you through this process.
Especially when it's so emotionally and
Oh, yes.
mentally tough, right? That people are going through. So having somebody to help navigate is a good way to approach that. So Delante.
Absolutely. And it kind of ties into Nick's point. We are in unprecedented times. And some of these things are strategy. And so if I sound like I'm on a soapbox, it is from a nonpartisan perspective. I want to be clear about that. But the structure of the federal government is changing in a way that I haven't seen during my lifetime. And so it's okay to be confused, frustrated, and lost because there are a lot of moving parts that don't really line up with how the federal government has been run for at least the past 30 plus years. And so if you find yourself having a moment where it's just a question mark bubble above your head like a cartoon, what's next? That's okay. And that's why you have people to talk to. That's why you have a support system. That's why you put a team together. And if I'm just being very transparent here, this blending of federal employees with the corporate nuance, are we going to change the GS levels? Oh, we're going to raise 1%. Maybe we'll do a freeze. Maybe we'll do a layoff. Oh, maybe we'll do just a complete shutdown. Maybe we'll do a continuing resolution. All these ups and downs from someone who's not experiencing it firsthand, it's stressful. So I can only imagine what it's like to go into the office every day. And with that, if it affects your decision making, that's normal. Physiological side effect of stress is just seeing what's in front of you and just trying to power through. Don't be that person who is afraid to ask for help, to ask questions, to reach out. Send an anonymous email, send an anonymous message on social media or something. Get help because this is an unprecedented time, a lot of moving parts. And if you don't see it, that's normal. That is absolutely okay if you can't see the entire board. It takes a team sometimes. And even the team may say, well, we don't know what's going to happen on October 1st. But to do it alone is very short-sighted and it could cost you a lot of money in the long run. So as we make these transitions, if it's not normally your style, try to just build it in, talk to someone about what can I do to make it to the other side of this and still have the retirement that I've always dreamed of.
And I love that sentiment. It's a great one to stop on that you both shared is build a team. There are people who want to support you and it's good to have a team behind you. And so that's a really, really good way to remind folks that they do have folks out there supporting them, even when it feels like a lot is shifting under their feet. So with that, that's all the time we have for this evening. Nick, Delante, thank you so much for joining us and for sharing your experience and your knowledge with us. And thank you to all of the folks on the line tonight. We know it's a busy time. We know people are going through a lot, and we appreciate that you're sharing it with us this evening. And please let us know if there are other questions, ways we can support you. Certainly, for the folks on the line here, don't forget to visit our FedSupport website. We're certainly part of your team back there trying to answer questions. And so you can find FAQs, blogs, previous webinars about a variety of topics out there. And again, thank you to everyone. Nick, Delante, really appreciate it. And we've got the website in the chat, and we'll be sending out an email with other resources. So thank you all, and really have a good evening.
Thank you.